Okay, thanks for having me, and thanks for everyone that's come out and spent your afternoon with us. Today, we're going to talk about using the futures and options market to do two things: diversify a portfolio and hedge a portfolio, and maybe even an idea on how to hedge your cash. Because what I've been reading is there's more cash sitting on the sidelines now than there has been really in quite some time, other than March 2020 during the COVID crash and the dot-com bubble. People have been generally more invested than they are now. So there's lots of cash on the sidelines. And believe it or not, there is a way to hedge your cash in a way. And I'll show you how to do that. My name is Carley Garner. I am a futures and options broker. We run a boutique brokerage shop in Las Vegas, Nevada. Ironically, we have very few local clients. All our clients are scattered around the country and the world. Not a lot of traders in Vegas, I guess, because they prefer casinos, who knows. But my name is Carley Garner. If you have any questions, comments, or concerns, you can reach me at that contact information. If you're interested in learning more about our services, we offer everything from discount online to full service and everything in between. You can reach us at decarleytrading.com, and we also have a lot of free educational material on the website. So if you just want to learn, you can do so for free. Our motto is an educated client is a better client. And if you're on social media, you can catch me on Twitter, Facebook, Instagram, and YouTube. I am a sucker for dog pictures. So if that's annoying to you, you may want to stay away from my social media page. Most people, when they think of Vegas, they think of desert, heat, and boring landscape. But believe it or not, these pictures were taken, that's Frankie, by the way, my beagle. But these pictures were taken about 20 minutes, maybe 20, I'm probably stretching it. It's probably about 25-minute drive from my house in Las Vegas. We have trees, we have green, and it's about 20 degrees cooler up on the mountain. I'm a broker and an author. I write a column for Stocks and Commodities magazine. I contribute content to Jim Cramer's Mad Money, and I frequent Bloomberg Television. If you happen to be a viewer, you may see me on the Options Insight segment with Abigail Doolittle. And I've also started doing an evening session with the Asian team. I also write a couple of newsletters that go out to our brokerage clients. You're going to see a few of those today, or at least some ideas that have been portrayed on the newsletters. And I have also written some books. If you're interested in learning more about trading futures and options, these are the only 3 books that I would recommend paying attention to in regards to the books that I'm not saying these are the only books you should read, but these are the only books that I've personally written that you should read. If you go to Amazon, you'll see there's probably about 19 books listed, something crazy like that. It's because some of these have been rewritten and republished with new publishers and updated content, that sort of thing. So just ignore all the other stuff. These are the 3 you want to pay attention to. And one more thing, there is a substantial risk of loss in trading futures and options, even though today we're talking about hedging and portfolio diversification. So the idea is to reduce risk. Futures and options trading itself without the combination of hedging a portfolio is extremely risky. And even if you're attempting to hedge, sometimes it backfires. So let's just say we're not investing in T-bills here. There's some risk involved. Now, I've talked about gold in this probably to a lot of you that are here, because for this, not this particular webinar or event, I should say, but for similar events. So we're not going to pay a whole lot of attention to the details in gold, but I just want to mention a couple of things. Gold is possibly the quintessential commodity. The idea is it's supposed to be a good store of value in bad times. It's supposed to be a quality long-term investment. Some people think it's a hedge against inflation. Some people think it's a safe haven. I think in 2022, we've learned, or we're reminded of, that none of these things exist all the time. In fact, sometimes gold does the exact opposite of what conventional wisdom would suggest it might do. For example, we just had the highest CPI print in 40 years, and gold has literally been melting down for 3 months. So it just doesn't always do what people expect it to do. but gold does have occasional times in which it performs very well. So this is kind of a boom and bust table of gold. You can see it'll have 3, 4, 5 years in which it outperforms, and then it'll do nothing for several years, maybe even a decade. So it's not the kind of thing you just want to hang on to and forget about. You don't want to hold on to it forever. You don't want to assume it's just always going to go up, although throughout time, it's mostly gone up, but it's been a really rough ride. If you bought the highs in 2011, it would have taken you a decade to get your money back. And that would have just occurred within the last year or so. So just letting you know, gold is not all that it's cracked up to be when you read about it. That said, it does have one benefit that I can't overlook, and that is it's a really great diversifier. I should always also point out this is a monthly chart of gold, and you can see that gold has had some really big corrections. It's the type of market that's boom or bust. A typical correction in gold can be anywhere from 25% to 40%. Even if gold just did a 25% correction from the 2100 high, we're talking like under $1,600. And so a lot of people would probably be shocked to see those kinds of levels, but the reality is that's just how gold behaves. That's the way this market works. Now, I will say that the lack of performance in metals, silver and gold this year probably has more to do with the skyrocketing US dollar than just about anything else. So there's a lot of moving parts here. But the one big advantage to gold is it's a diversification tool. So most people assume that gold and stocks move in the opposite direction. In other words, when the stock market's going down, they think that gold's going to be a hedge against that and vice versa. But that's really not how it works. In fact, they generally have either a positive correlation or sometimes they're not correlated at all. They're very rarely negatively correlated, although they can be. So the point is, gold is a very good diversification tool. And what I mean by that is gold is going to do its own thing. It's not necessarily a risk asset. It's not like, for example, there was a lot of traders were assuming that Bitcoin was an inflation hedge or a risk hedge. And as it turns out, it's a risk asset, meaning Bitcoin and the S&P or Bitcoin and NASDAQ were very highly correlated. You don't really see that in gold. Sometimes it is correlated, sometimes it's not. So the reality is gold is great at just having something else in your portfolio that might not necessarily trade with stocks. And it's easy to get access to. So gold futures is the cleanest and easiest way to gain access to the gold market. It's better than bullion, and I'm going to tell you why. And I know a lot of people are saying, yeah, but the leverage and the risk and all of that is true. Gold futures have a lot of leverage built in, which makes them extremely risky, but that doesn't mean you have to use the leverage. You can overfund your account, which basically removes the leverage, and it's just as efficient. Well, no, I should say it's more efficient as holding gold bullion or holding a gold ETF, because if you remove all the leverage, all you have is a contract that trades 23 hours a day, has a tight bid-ask spread. You can get in and out of it as much as you please, and it's going to follow the price of gold almost exactly. If you've ever bought bullion, you know you have to store it, you have to transport it. It's illiquid. When you go to sell it, you're going to shave a couple $100 off the top of the price just to get somebody to take it off your hands. And also, on a side note, futures are more tax efficient than almost any asset. You get a 60-40 blend between long-term and short-term capital gains. So if you do make money in the position, you're going to pay less taxes than you would if you were holding the ETF or the bullion. And if you do want to use leverage, you can certainly use it. It's there for you. But the idea of this particular event in class is investing, not necessarily active trading. So we're going to talk about buying gold efficiently without any leverage. And so what that would mean, if you were trading the original gold contract, that's 100 ounces of gold, the value, assuming gold is at $1,800, which it's actually a little lower, but we'll just go off of this. If the value is $1,800 in gold, A full-size contract represents $180,000 worth of gold. So if your portfolio is big enough to justify that type of an allocation of gold, and I'd say the average person probably doesn't have one that large or the need for that much gold, but if you did, you could simply put $180,000 in a trading account and buy one gold futures, and there you go. You've not only eliminated all the leverage, but you've purchased the most efficient exposure to gold you possibly could. If you only needed roughly $90,000 worth of gold in your portfolio, you could do the same thing, put 90,000 in an account and buy a mini gold contract. If you only wanted about 60,000 in gold, you would put roughly 60,000 in an account and buy one single kilo gold. So you see where I'm going here. If you only needed $18,000 worth of gold allocation, you could buy one micro futures contract in an $18,000 to $20,000 account. You have no leverage and you've diversified yourself. You have an asset that's not going to be correlated to stocks and maybe not bonds either. I know that gold and bonds have been quite correlated this year at times. And the reality is sometimes they're not. The Treasury market bottomed out a month or two ago. Well, not two, a month ago. Yet gold has yet to find a bottom. So while they were trading in the same direction 2 or 3 months ago, they've broken their correlation. So again, gold is kind of has a mind of its own. I'm not saying it always goes up. I'm just saying it's not correlated with other assets. So it's a really great way to get some diversification. Oops, I got a little ahead of myself. So we talked about a very efficient way of diversifying through gold futures using the mini micro. I'm going to show you a way to be a little more aggressive with it. This is a, whoops, let me switch my application here. Okay, so you should now see the one of our newsletters, the Carley Perspective. We sent this to clients a couple of weeks ago now, to be honest. Wish we would have waited because gold just cannot get out of its own way. But with that said, if somebody is looking for periodic gold exposure, if you remember, I showed you that chart of gold, and sure, it's been going up over time. If you take a time frame of 30 years, yes, it's been going up. But if you take a time frame of 5 years or even 10 years, it doesn't necessarily go up during those types of periods. It might go up for 1 or 2 years very sharply, and then it might go nowhere for several years. That's just the nature of the market. So if you are going to use gold as a diversifier, I would say the idea should probably be to gain the exposure when gold is cheap. Now, unfortunately, we don't ever know when gold is cheap enough to find a low until it actually happens. And the market moves quick. But with that said, gold here in the 1700s, mid 1700s is probably relatively cheap. We've seen the market bottom out here a couple of times last year. Now it could certainly go lower, so you want to give yourself room for error. But if the idea is to gain exposure on gold when there's an opportunity and not necessarily just always have gold on, you might consider doing it with options, and that way you can pinpoint your speculation, you can adjust your risk based on your tolerance and what exactly you're trying to do. So this is an option spread that would give people exposure to gold with some room for error. This is using the December options. At this point, let me see, at the time of this newsletter, there was 138 days to expiration. I think there's more like 120 days to expiration, somewhere in that ballpark. So we're talking quite a bit of time. And all that really needs to happen is, as long as gold stays above 1625, we can't really get hurt too badly. If we're just dead wrong and gold melts below 1625, we can get into a little bit of trouble because we have unlimited risk. Anytime you sell a naked option, you have unlimited risk below the strike price. So in this particular case, we'd have unlimited risk below 1625. It's almost like being long a futures from 1625. So let me explain how a trade like this might work. Okay, so This is the idea of this trade is to make money if gold goes up. So we're purchasing an 1800 call hypothetically, but that call is very expensive. Let me scroll down a little here. If we were just going to buy this call outright, it would cost about $6,000. So anybody that's ever purchased an option knows that unless your timing is perfect, it can be tough to make money because you're paying $6,000 for an eroding asset, and you're paying $6,000 for an asset that basically could expire worthless, or maybe it won't. It has, I mean, depending on what your conviction is in this trade, my guess is it's probably only a 20 or 30% chance that it expires worthless. But according to math, it's actually an at the money option has a 50% chance of expiring worthless. So it's not impossible, let's put it that way. So if you wanted to buy this option, it would cost you $6,100 or $6,000, a little over $6,000. If you wanted to use the market's money to pay for that, you could sell the 1900 call and then also sell a 1600 put. And you can see we're collecting a good amount of premium for those options, and it makes the trade free. This is the bid ask, meaning if you bought the spread or sold the spread, these are the premiums you possibly could get filled at. And basically this is close enough to even money. So we essentially are collecting enough premium for our short options as we are paying for our long option. So it's an even money swap. It's a free trade, but by free, I don't mean risk-free. I just mean it's not going to cost you any money to get in, but it will cost you a margin. So if we scroll down here, we can see stats in detail. The margin's about 4,700. So you would be tying up, I would say you probably want more than that in an account to do this. I'd say you probably want at least $10,000 to $15,000 in an account to put this on. And again, this would be to hedge your portfolio, or I should say diversify your portfolio into a different asset class if you feel like it's beneficial to do that sort of thing. If gold is between the strike price of the long call and the short put, the spread expires worthless and you really don't lose anything other than the transaction costs and your time and the margin money you use to tie up for the position. If gold is above $1,800, you start making money between $1,800 and $1,900 with a max profit of roughly $10,000 minus transaction costs and minus what you paid to get into the trade. So you're not putting up a whole lot of money to get into this. You're just accepting unlimited risk below 1625. But if you're doing this as a portfolio diversifier, you might have the mindset that, hey, I wouldn't mind being long gold from 1625 anyway. So if gold did get down there and did cause you a little bit of stress, you could take delivery of the futures. And of course, you may have to roll it into the next contract month, but the idea would be being long from 1625 probably isn't the end of the world. If gold just goes up from here, great. This did what it needed to do. It diversified your portfolio and you're hopefully a little better off. We put out a similar idea in silver. I'm not going to spend too much time on this, but just want to show you that that sort of thing can be done in gold or silver. A lot of people are attracted to silver because it's also an industrial metal. So it's not just a value that humans have put on it. Like, for example, gold. We can argue all day if gold is really truly a valuable asset or not. Some people think it is, some people think it's not. But the reality is it's only valuable because humans think it is, a lot like art or baseball cards. That said, silver does have some manufacturing qualities, especially in electric vehicles. Ironically, those electric vehicle stories and all those fundamentals calling for the use of silver in manufacturing really haven't resulted in higher silver prices. Silver, like gold, has really had a tough year. And I don't think many people expected that coming into the year. I know we didn't. We were thinking gold and silver would have really great years. And it started out good. And then once things turned around, it's been rough ever since. But you can see we're on a bit of a pivot line here, and it's either make or break. Either silver holds the $18 to $18.50 area and goes much, much higher, or silver probably doesn't go up much again ever. That might just be the nail in the coffin if we break down from here. I don't think that's going to happen, but you can do a similar strategy in silver. Again, just pointing this out, buying a call, selling a put, getting a very cheap trade with unlimited risk below the option you sell. This is a very aggressive speculative trade. So if you're doing it purely for speculative purposes and you're not interested in being long the metals from down around these short put strike prices, just beware that gold and silver can move very quickly, and especially silver, it can be quite treacherous. I've seen silver move $3 or $4 in a single day. And I've seen one particular account, it wasn't one of my clients, thank goodness, but it was an account at a brokerage that I used to work for. He was mostly long silver and short puts and long some calls as well. But he basically went into the day with $300,000 or $400,000 in the account, and within hours, his account had a negative balance of about 300,000. So it was a $600,000 or $700,000 swing in a couple of hours, and he didn't have he had a big position, but it wasn't huge. I think he was trading like 10 and 20 lots. So just to give you an idea, you don't want to be asleep. You don't want to go to sleep in silver. Silver is the market that can pay off really well if you're on the right side, but if you're on the wrong side, it's not so fun. Okay, so let's start talking a little more about stock portfolio hedging. So rather than diversifying, we're going to talk about outright hedging. Hedging is the practice of taking an offsetting position in a related asset or security to reduce the risk of adverse price movement. The futures markets, ironically, were created for the purpose of hedging. 95% of the people that are participating in futures are not hedging. Trust me, they're speculating, and they're usually swinging for the fence. But the futures markets were truly created to shift risk from the hedger, who's generally a producer or an end user, to a speculator. Hedging is analogous to purchasing insurance. If you're buying puts and calls to hedge your price risk, that's basically what insurance is. The perfect hedge doesn't exist in reality, but if it did, it would eliminate all price risk. The reason it doesn't exist is markets are not perfectly efficient. Assets are rarely perfectly priced. And why are they rarely perfectly priced? Well, because humans are involved, right? We're emotional. Sometimes we act irrational, and it pushes prices beyond equilibrium levels or beyond reason in a lot of situations. Also, there's transaction costs, slippage, et cetera, that interfere with the theory of a perfect hedge. But the closest you can get to a perfect hedge is to sell a futures contract, specifically on one of the stock indices, depending on what your portfolio looks like. If you, hypothetically, if you had, and by the way, this is late last year, not current prices. From current prices, I mean, obviously the S&P is at around 3,900. I probably wouldn't be an aggressive hedger from 3,900. I think the place to hedge was when we were in the high 4,000s in the S&P. Of course, you know, that's neither here nor there. We could very well go much lower in the S&P, but it's a lot harder to hedge after the fact than before the fact. It's kind of like trying to buy insurance after your house already burned down. It's too late. In a few minutes, we're going to show you a way to hedge your cash position. So for example, if you've cashed out and you're sitting on the sidelines, but you don't want to miss an up move, you can actually hedge your cash position should we get an up move, and I'll show you how to do that. But this is just to give you an idea of if and when the stock market goes back up again, and it will. Eventually you'll get to lofty prices and we'll all wonder, how the heck can it keep going up? You know, much like the last couple of years, a lot of analysts were scratching their heads wondering how the S&P could go up every single day, or it seemed like it anyways, against lofty PEs and so on and so forth. So that's going to happen again. It's just not now. And when it does happen, you might consider hedging your portfolio, and it might look something like this. So late last year, a hedger could have sold a single E-mini S&P future at about 4,500. Doing so locks in the price. So if that person had $225,000 worth of S&P 500 stock. Maybe it's SPX, maybe it's a well-balanced portfolio, whatever it is. If you have $225,000 worth of that stock sitting around and you realize, hey, I want to keep getting the dividends and I don't want to trigger a tax event, so I don't want to sell, but I know that these prices are probably pretty lofty and I know there's a good chance that things at some point in the future roll over. You could consider locking in your price risk. You basically go short a futures contract and it locks in your price. So you're still getting your dividends, you're still invested, but for every point that you make in your stock portfolio, you're losing on your futures hedge and vice versa. So if the S&P sells off from where you put your hedge on, your hedge makes money and your portfolio loses money, but they balance each other out, assuming it's a perfect hedge. Again, it's never going to be a perfect hedge, but you get the idea. If the S&P continues to go higher, your portfolio makes money, but your hedge loses, but it balances out and you still get the dividends while you're waiting. Other people like to hedge with the purchase of put options. Now, in an environment like we are today, where the market consistently seems to be going down, rallies are sold into, rallies fail, that sort of strategy might work out. But markets, or the stock market anyway, is designed to go up. Over time, it almost always goes up. Unlike gold, which I just showed you, doesn't do that. The stock market does. So if you're just buying puts over and over and over, you're going to end up spending way too much money and it's going to do you more harm than good. Puts are expensive and they're eroding assets. And not only that, they're only a benefit to the hedger if they actually cash out. I have seen a lot of people put on put hedges. The market sells off, their put's making money, it's doing exactly what it was designed to do, but they never sell their put. They just let it go. And then eventually that put loses value because the stock market returns to a more normal state of flux, goes up. So even though they put on a hedge and it worked, they actually didn't sell it at a profit. And so once again, the put options or that hedge cost them money. If you kept buying puts after puts after puts every 3 months or every 2 months after expiration, could get really, really expensive. This is just an example, and keep in mind the cost of those puts or the cost of that portfolio insurance is dependent on the VIX, so the volatility, the implied volatility. So there's a lot of things going on, but the point is it's very expensive. So this is an example when the S&P future was at 4150 with 60 days to go. This was a couple months ago, I believe. To buy a 3850 put, it would have cost you 45 points or $2,200. It's only going to pay off if the S&P drops from 4150 to 3850, and even then you're still losing money because it has to drop 45 points below that just for you to get your money back. If you decided to buy the 3600 put and just have catastrophic insurance, it's still going to cost you $1,100. So if you were insuring $200,000 worth of S&P stock on a decline of 300 points or more for 60 days, it's going to cost you about 1% every quarter or 4% annually. If you only wanted a insurance against a decline of 550 points or more, it's going to cost you about 2.5–3% annually. Well, if you're a buy and hold investor, the stock market generally, or the S&P generally, only goes up 7 to 10% on most years. I mean, I know the last couple of years have been a little abnormal, but if you're spending 3, 4, 5% to insure your portfolio, you're not coming out much ahead, and you're probably not shaving your drawdowns off either. If you're not actually taking profits on your put, you're just spending all this money for peace of mind, but you're not actually benefiting financially. In fact, it's a really big drag on your portfolio. So here's another way to do that. Like if you want insurance on your portfolio, instead of spending a fortune on a put option, you could consider you could consider selling a call to pay for your put. So this is what this might have looked like at the end of last year. You're selling a 46.50 call for 40 points. You're buying a 42.50 put for 40 points. So you can see it's even money. You're selling an option for 40 points. You're then buying an option for 40 points. It's not costing you anything. The margin was about 9,400 at the time of this. This was, again, in late October, early November. So this is a free hedge. This is free insurance below 42.50. If you have this trade on and the market drops below 42.50, your portfolio is hedged dollar for dollar under that strike price. And you didn't pay anything to get out. I'm sorry, you didn't pay anything to get in. The opportunity cost of this is, in addition to the margin, the $10,000 you need in margin to hold this hedge, if the S&P would have gone above 46.50, and actually it did temporarily, your portfolio would have been capped. So above 46.50, you're not making any money. For every point that you're making on your portfolio, you're losing on your hedge and vice versa. But if you did this trade and gave the market 150 to 200 points on the upside to move every 2 or 3 months, you'd probably wouldn't really be giving up that much on the upside. And again, you'd only want to do this sort of hedge if the market was lofty. You probably don't want to do this hedge when the market's at 3,700, but at 4,700 or 4,500, it's probably a good idea to have this sort of hedge on, because as we were reminded, markets don't go up forever. So here's a concept that I would assume that most people haven't really even thought of this before, because the reality is there's really not a lot of opportunities to think about hedging cash, but there's a time and place for everything, right? So this is a weekly chart of the S&P futures, I should clarify. And I know there's a lot of opinions out there. Are we at the bottom? Are we not at the bottom? The reality is nobody knows yet. We won't know until we know. And at that point, it's going to be tough trying to chase prices higher, right? That's just how it works. Our analysis suggests that from a seasonal standpoint and a chart standpoint, there's probably a pretty good chance we have one more leg lower. And of course, we could be wrong, but this is our thought. And if that does occur, we think that somewhere around 3,500 to 3,550 is a place to consider being a bull. That doesn't mean that it's going to turn on a dime there. Maybe it goes a little lower. Maybe it doesn't quite reach that level. But in that level, that's where a lot of the moving averages that we watch come in. That's where trend lines come in. That's basically where the market broke out from in 2020. So there's a lot of things that converge right around the 3,500 to 3,550 area that suggest at minimum we should stop going down, and maybe even we put in some sort of a long-term bottom. Again, this is an art, not a science, and things can change quickly, and we could be wrong. But if you thought that that was the case, and let's say that you were prepared for this correction or have recently been pushed to the sidelines, you just couldn't take the pain anymore, so you liquidated a lot of your portfolio. If you're sitting on cash at this particular moment, and I know there's a lot of people that are, I mentioned earlier in the class that we've seen signs that there's more cash on the sidelines now than maybe ever, and if not ever, at least more than we've seen at any other time than the COVID crisis and also the dot-com bubble. So in the big picture, a lot of people have cashed out, and a lot of people are sitting on the sidelines waiting for some sort of sign to get back in. If you're that person and you're looking at the market go up today, wondering if you should chase prices or if you should just wait and see, maybe there's a better solution. Maybe there's something that makes sense, and that might be something like this. This is a risk reversal. It's the exact opposite of what we were just looking at before to hedge a stock portfolio. If you have cash, but you don't want, and you want to hedge your cash. And what I mean by hedge cash is you don't want to miss the upside. If the S&P starts rallying, you don't want to be left on the sidelines wishing that you never would have hit the sell button, Here's one way to kind of get the best of both worlds. You could consider buying a call option and selling a put option. The idea is if the market rallies above 41, let's just talk about at expiration numbers. If the market is above 41.25 at expiration, you're basically long from 41.25, because as the buyer of a call option, you have the option to buy the futures contract, which is roughly, I'm rounding here, but roughly $200,000 worth of stocks. So you would have the option to be long from 41.25 if you wanted it. If the S&P did not rally above 41.25 and it settled somewhere between 35.25 and 41.25, your spread expires worthless. So no harm, no foul. And by the way, I should have mentioned, you can buy, as of today's prices, I mean, and this could change quickly, but as of today, you could buy the 41.25 and sell the 35.25 at even money, meaning you get into this with no cash outlay. Very similar to the previous example we were looking at. If the S&P drops below 35.25, it's like being long a futures contract from that price. If you're using this as a hedge against sidelined cash, it's not the end of the world, right? If your buy level is 35.25 or somewhere in that vicinity, meaning you have cash on the sidelines that you want to put to work in the market at around 35.25, if you do this trade or this hedge or position, whatever you want to call it, and the futures price is below 35.25 at expiration, you get assigned one futures contract, which at that point represents about $175,000 worth of stock. So there you go. You've just very efficiently gone from being in cash to having a position in the market. And from there, you can consider, consider yourself invested. Now, if you're doing this without having cash sitting on the sidelines, that's a whole different story. That's just speculating, which is fine, but that means you have very leveraged and substantial risk below 35.25, because if it goes down there and you don't have cash sitting on the sideline and you didn't have any intention of putting any sideline cash to work there, you're basically just long a futures contract with no backing and no plan. And that's not necessarily what you want to do. So this is only for those people that are sitting in cash. Now you might be saying, I don't have $200,000 in cash on the sidelines, but I want to do something like this. You could use micros. The micro options can handle the exact same strategy, but at 1/10 of the size. So if you have roughly $20,000 in cash that you wanted to hedge in some sort of way, you could do one micro and it would take care of $20,000 in cash. And again, if you're assigned a futures contract from 35.25, at that point you could continue rolling the futures, but at some point you'd probably want to buy into the stock so that you receive dividends, because futures don't pay dividends. Futures are leveraged, and that's the advantage of them. And they trade 24 hours, but they don't pay dividends. So if the point is to get into the market at that price, at some point you're going to want to switch your futures contract into the stock market. But that's you'd cross that bridge when you get there. There's one other thing I want to show you here, because you may think I'm a little bit crazy for even suggesting that maybe the stock market might go up. I know it's not a popular stance. This is a newsletter that we sent to our clients today, and it actually was also published on Real Money or thestreet.com. I know not everybody likes the idea of being bullish in a market because everybody else is bearish, and I totally get that. I mean, obviously, the stock market's just been pretty treacherous this year. Every rally's been sold into. It hasn't been a place for the bulls. It's been a lot of pain for a lot of people. That said, we're starting to see some things that suggest that maybe we're getting near. There's some light at the end of the tunnel. I'm not saying we've seen the lows and we just go straight up from here. Maybe that's the case. I doubt it. I think we do have one more flush lower. But if you follow the COT report, the COT report is the Commitment of Traders report. It's issued by the CFTC. And it is basically a report that comes out every Friday that tells us how people are positioned. They basically give us 3 categories. It actually gets more complicated than this, but I'm going to keep it simple. They give us 3 categories: large speculators, small speculators, and commercial hedgers. Commercial hedgers are not trying to buy low and sell high. They're just hedging their portfolio risk. So some people pay attention to that. I kind of ignore them unless they have a really large and outsized position. What I pay attention to is the large speculators. Large speculators are those traders that have extremely deep pockets. They're trading very large position size. Each market has position limits, and most retail traders aren't even aware of that. But if you trade more than a certain number of contracts in each market, you're considered a large trader according to the CFTC. And then you're categorized as such in their report. So what I look for is if the smart money or large traders are getting a little ahead of themselves, they're getting out over their skis. Are they too short? Are they too long? And in this particular case, we're seeing in the S&P, there's signs of them becoming a little too short and maybe a little too complacent. We've seen very large net short positions from this group in recent history. You can see in March of 2020, and then again in late 2018, early 2019. Both of those instances were around the time the market bottomed. In fact, they actually got a little shorter going into the bottom and then eventually covered. Now, these large speculators have really deep pockets. They can be early, they can be late. They're not like us. We would run out of money. If we're trading on leverage, we'd run out of money before that we were able to get back on our feet after something like that, if we were late to a bottom. But if you're talking about a stock portfolio that's buy and hold and you're investing, not trading, that's a different story. You may look at this and say, hey, these people have already sold probably all they're going to sell, or at least close. I just told you there's more cash on the sidelines now than we've seen in a long, long, long time. And very few times in history have we seen more cash on the sidelines. So the mom and pop investors, maybe those that wanted to liquidate have already liquidated. Maybe the speculators have already gone short if they want to go short. So perhaps we haven't seen the bottom, but we could very easily get a really big short squeeze. And maybe we have seen the bottom. In March of 2020, not everybody thought that the bottom was in. Everyone was looking for a retest, and the market just took off and really never looked back. So we don't know until we know, but there's some signs that perhaps maybe the sentiment is too bearish, the trading is too bearish. And it sounds counterproductive, but the thing is, if everybody that's bearish has already sold, that means liquidated their portfolio or sold to go short in their spec accounts. If everybody is sold, it doesn't matter what the fundamentals are. The fundamentals can continue to be bearish and the market can go up. Markets turn around and go up before the fundamentals change. We just were reminded of this in crude oil. When crude oil was at $120 2 or 3 weeks ago, people on Twitter were like swearing at me when I suggested maybe there's a chance that crude oil might go down. People got really irate because all they saw when they opened the paper or turned on the TV was how tight crude supplies were. Nobody believed oil could go down. We saw the same thing in wheat. Wheat prices went from $13 to $8, actually closer to $7 even. And that happened a very short amount of time. And as wheat was topping out around $13, the mainstream narrative was we're in a global food shortage, people are going to starve, we have no wheat. I remember my mom calling me and wondering if she went to the grocery store, if there's going to be one day no crackers on the shelf. That's just how wild that story became. And that's exactly when the market topped out. So just when things seem the worst is probably when the market's going to turn around and go up. Now, I'm not saying that we've seen that yet, but we'll see. It's possible. This is what we're seeing on a daily chart. And you can see that today's trade actually broke the downtrend line. I'm wondering, we'll see how it goes tomorrow, but if tomorrow we get some follow through, we could get some really big short squeezing here. I just mentioned to you, everybody's already short. So just short squeezing and stop running and all those sorts of things can put us quite a bit higher. And I know this is hard to imagine, but it's not impossible to see prices go much higher. And we're talking like 4,350, 4,400 up here. So it would be a really substantial move. In the meantime, we'll just see how it does with some of the closer resistance levels. 4,000 is going to be a big one. Okay, we'll go back to the slideshow. So in summary, I just want to remind everybody that precious metals don't have to be off limits. They're scary, they're no fun, but they are a great portfolio diversifier. And again, trust me, listen, I'm not perfect. 2022 has not been our year. I could tell you that. We've been bullish gold and silver. And again, it worked out in the beginning, but the volatility was really, really wild and it was tough to hang on to for a lot of people. So sometimes, sometimes things are just a little out of hand like this year, but the reality is what you should be looking for in metals if you want to diversify your portfolio is don't chase prices. You don't want to buy gold at 2000, but any really large dump in gold is usually a buying opportunity. I showed you a chart several slides ago, and if you go and revisit a chart, if you look at a weekly chart, monthly chart, or even a daily chart in gold, you can see it's just the kind of market that literally flushes everybody out, makes everybody wish they never had heard of gold or silver, and then that's when it goes up. So just keep an eye out for those opportunities as a way to diversify your portfolio. Also, be aware of the fact that most brokerages don't offer futures or you need special permission. So make sure that you're set up and ready to go if that opportunity presents itself. And don't forget that although the futures markets are used primarily for speculation, they were created for hedging purposes. So if you wanted to hedge your portfolio, whether it's the S&P, and by the way, I mentioned that risk reversal trade to hedge the S&P, but you could do the same thing in the NASDAQ or the Russell or the Dow. So if you had a portfolio of all of those indices, you could maybe do a micro in each. And again, each micro is roughly about $20,000 worth of stock. So if you had a very well-balanced portfolio, you could do one micro of each of those indices and have a really great hedge on. I just showed you how you could hedge your cash, but keep an open mind. You could also hedge your treasury risk. If you think interest rates are going up or down, you could do something very similar using in your note futures and options or Eurodollar futures and options. Eurodollar is a 3-month interest rate tool. So there's all kinds of things you can do. Just be creative. And if you're interested, again, in our brokerage services, we'd love to have you. You can please visit our website, carleytrading.com. Lots of educational material, hopefully something useful in it for you. And if you do decide to trade futures and options, we hope that you do it with us. If you're interested in learning more about the risk reversal strategies and even the option trades that we talked about in the metals, my book, Trading Commodity Options, covers it in quite a bit of detail, almost painful detail, but that sort of information is needed. And if any of you are wondering about Jim Cramer, he is truly a very, very nice person. Some people don't believe me because they watch his show and they see that he's very boisterous, but the reality is he's actually a very humble and very nice person. And I was lucky enough to have him endorse my book. He's a friend of mine, and yeah. Once again, here's my contact information, and I hope to hear from you if you have any questions. If anybody has questions now, not sure if we have time to take questions if anybody has any. Well, we can, since I've got a little extra time, let me go to, I'm gonna pull up a chart at crude oil. Not because I am going to pretend I know what crude oil is going to do here in the next couple of weeks, but just want to, crude oil is obviously having a big influence on the market. So whether or not, I'm not telling you should speculate in crude oil, but if you are handling a portfolio for yourself or for others or whatever you're doing, it's a good idea to have an understanding of what oil is doing and maybe what it might do in the future. So we've had a really big run in oil from about $90 up to 103, 104. There's a couple things that are going on here though. The August contract expired today. So this is the last trading day for the August contract, and you can see it expired right on a trend line. So you may or may not have noticed any of the information we put out on social media or on Bloomberg last week, but we were looking for 90 to hold and for a big bounce. We said somewhere 10 to $15 could be in the cards, and we got it. Now, what it does from here is anyone's guess. We're sitting on trend line. My best guess is we probably roll over and just come right back down. I know it's hard to believe, but oil could very easily trade in the 80s, in the mid 80s. There's a lot of fundamental stories out there, but the sanctions really aren't working as planned. Russian oil is still coming to the market. It's just being sold to different buyers at cheaper prices. US producers are really, really slow to get off their tush and bring supply in, but they're not necessarily comfortable in investing a lot of money given the green energy agenda. So there's a lot of things going on, but the one thing I always know about commodities is high prices cure high prices. So regardless of how scary the fundamental story is, it always resolves itself eventually. And if you don't believe me, let's look at a monthly chart. Okay. This is a monthly chart of oil. And there's, over the years, I've been doing this for a long time. I started as a broker in 2000, I think it was 2003, but maybe 2004. Anyway, I've lost count, a long time ago. One thing that I've learned is even when it just seems impossible for something to happen, it absolutely can happen. So in 2008, we saw crude oil top around the summer months. It topped out in July and bounced around for a month or two and literally sunk from $145 a barrel to $30 a barrel. And it happened very quick. And it happened right when, at this time, if you turned on your TV, all you would hear is we're running out of oil, gas prices are high, we're in trouble, there's an energy crisis. And literally weeks later, we're crashing. And I've told this story before, but I'll tell it again. The market peaked out in July of 2008. My mother bought a Prius a week or two before. I think she bought in early July and the market topped out in later July, something like that. But my mom bought a Prius with the idea that gas prices will never go down again. And it's the only way she could survive the energy crisis. So here we are. Crude oil has never traded at 140 to 150 again since. But at the time, it really seemed like oil had zero chance of going to $30 a barrel again. We've seen that a few times on the opposite end as well during the financial crisis, during the supply glut of 2016. One very popular TV analyst came on TV and said, we will never see crude oil above 44 again in my lifetime. And literally a month later, we were above 44 and really haven't spent much time below since. Sometimes the narrative that is deafening and overwhelming and it seems obvious is actually coming to an end. Once everybody and their dog knows about it, it's probably over. If you're talking to your friends on Facebook who are, have pay very little attention to what's going on in the economy and markets, and they know the price of oil, that's how you know things are probably a little lopsided when it comes to fundamentals. And we're probably at the end of the story rather than the beginning. We also have pointed out that there's this trend line that crude oil has been, it used to be resistance. And since the war broke out, it has become support. My best guess is at some point we break below that, and it's going to be somewhere below 90. The comfort zone in oil, this is hard to hear, but the comfort zone in oil is $50 to $75. We may not see that this year, but by next year, my bet is we'll see $50 to $75 oil. So we'll see how things go. But the good news is if the crude oil market and the commodity markets normalize, that takes pressure off the Fed and takes pressure off the interest rate market, and everything comes back into line, and suddenly stocks seem cheap again. So keep an eye on the crude oil market. Things seem bad, but they're probably not going to stay bad forever. Okay, somebody's asking about, so someone's asking if I think crude's going up or down. I'm just seeing this now. Sorry, I missed it earlier. I tend to be long-term bearish crude. I was short-term bullish crude until this little last run. Now I'm waiting to see what it does with resistance. To be honest, I'm just completely neutral in the short run. What it does in the next couple of weeks, I have no idea. I give it a 50-50 shot either way. What it does in the next several months, I think any large rally is a selling opportunity. So we'll see how things go. And somebody's asking about wheat. I think wheat is getting really close to a buying opportunity. The market has priced in a lot of the Russian and Ukraine wheat coming to the market, yet it hasn't yet come to the market. And even if it does, we still had a lot of weather issues and other things that went wrong this year for wheat. So it's really, the best way for me to put it is $13 wheat was unsustainable. That price is unsustainable. But I also think that $7.50 for wheat is also unsustainable, at least for now. So I think somewhere between here and let's say the low 70s is probably a really good buying opportunity. So we'll see how things go. I think there's probably some opportunities for option spreads similar to the metals option trades that I showed a few slides ago, where you can buy a call spread and maybe sell a put to pay for it. But you want to be careful. This has been a really wild year in wheat. It hasn't been forgiving if you are on the wrong side. Okay, I appreciate everybody coming out. Once again, please visit us at TradingResearch.com or let me know if you have any questions, comments, concerns. You can email me at cgarner@TradingResearch.com.